First of all, thank you all very much indeed for coming here this morning to Policy Exchange. We're delighted to welcome you all. We're particularly delighted to welcome the Norwegian Finance Minister, Siv Jensen. This is a very good day for any finance minister to be speaking in the United Kingdom because, of course, it's the start of our financial year. This is the first day of the new financial year. This is the day when personal allowances change, detailed tax changes begin to take effect. So this is a good moment for a finance minister to be performing in London, wherever you may come from. But it's a particular pleasure to welcome our Norwegian guests, because there's a special and particular relationship between the United Kingdom and Norway that goes back a very long way. It's exemplified by the Christmas tree that the people of Oslo give us every year, and don't underestimate it. We all love the Christmas tree. Many of us have a passion for football, and I think many of us end up actually supporting the same football clubs. But more than that, there's been a very real political interest in the United Kingdom, in Norway, that goes back a very long time. And part of this political interest actually turns on your relationship with the European Union and how you chose to actually handle it. And right at the start, in the early 1970s, people said, look, in Norway they've had a referendum and the people have made a decision, why can't we have a referendum? And we did have a referendum in 1975. But throughout the many years of Britain's participation with its partners within Europe, there were many people who said, well, Norway's had 2 referendums and they haven't chosen to sign up to the full Treaty of Rome. Maybe there's an alternative that we could pursue. So the Norwegian approach to Europe has always been a matter of interest, and of course in our debates in Brexit at the moment has had a renewed technical vigour, if I put it that way. But of course we've both had oil, and how you handled oil and how we handled oil was very different, both in terms of the structure for extracting the oil and the ownership of it, and of course the construction of the sovereign wealth fund that you have, which we are fascinated by, we envy. I'm not sure whether it was ever really an option for the UK because of the size of our economy, and we've always had what you might call a sovereign debt fund. So we're in a slightly different position. And then also, of course, you, Minister, actually lead a party, a very interesting party for us, the Progress Party in Norway, which of course emerged in its origins from the first reservations that people had in the early 1970s about the costs of the post-war Keynesian welfare society. And I think that there was a sort of parallel reservation expressed in the politics of Denmark and Norway. And of course, the government of Norway, in its recent tax commission, has taken head-on some of these big questions about an ageing society and actually how you handle that with lower productivity and potentially, of course, in your case, the future evolution of oil revenues. And it's not just about thinking of your tax rates and tax system in terms of marginal work incentives. It's the aggregate tax bill, the aggregate tax burden, which I think your Commission quite rightly says is something you can't flinch from trying to constrain if you're not to crowd out your private market part of your economy. Today's focus of the Minister's speech is going to be on monetary policy. And it's a serious speech that is going to explore the big issues that affect many advanced economies, including the United Kingdom, most of the Eurozone, and certainly the United States. And it turns on things like the structure of your housing market. You've got a housing market much like ours. You could say messed up. Messed up both in housing supply and planning policy, and certainly in your case, you have some quite complex tax matters that actually relate to it as well. A housing market so complex and distorting that actually has an impact on the conduct of monetary policy and the supervision of banks. And of course, these are some of the questions that were well in play before the great crisis in 2007 and probably have not been fully addressed either in the United Kingdom or in other advanced economies since the crisis in 2007-2008. And of course we've got all the consequences of where do we go now after this protracted period of very low rates of interest. And I think anyone interested in these sorts of things will find the Minister's speech very interesting, because she doesn't flinch from setting the exam questions that I think all central bank governors and finance ministers have got to have a crack at answering, and she's been good enough to show some of her homework as an approach perhaps to answering those questions, including the future of the inflation target. So without any more fuss, we're thrilled to have you here. Thank you very much, and I'm certainly looking forward to it.
thank you very much for your introduction. Let me just start by saying that the financial crisis in Oslo in the late 1800s, the so-called Christiania crash, left deep scars. Not only among ordinary people who saw their fortunes evaporate, but also in the city's physical landscape. Large parts of today's city centre in Oslo were built during the housing market frenzy of the 1890s. When the housing market collapsed in 1899, building activity came to a more or less complete standstill that lasted for years, leaving the architecture of the 1890s as one of the city's distinctive characteristics. It took 90 years for house prices in real terms to recover most of their losses. A new financial crisis was then approaching. In recent years, house prices have surged once again, fueled in part by low interest rates at home and abroad. The housing market is at the core of much of our work on financial stability. For obvious reasons, my speech will focus on our own initiatives, how we apply European rules and regulations, and use a combination of different instruments to promote financial stability. To own the house you live in is of great value to most Norwegians. Owning a house can give a sense of safety and security, especially in a country where a long winter season is predominantly wet, cold and dark. In Norway, 80% of households own the house they live in, and the majority of households' assets are tied up in their home. The UK also has a relatively high home ownership rate of about 65%, I believe. Strong public interest in housing market developments illustrates the important role that housing plays in the economy. Not a day goes by without the housing market being mentioned in the news. Hence, it is of great importance to us, as well as for many other countries, to have a well-functioning and efficient housing market, characterized by sensible regulation and reasonable construction costs. Asset prices and debt tend to move hand in hand. Periods of rapid economic growth are often accompanied by exuberance on the part of firms, households, as well as the financial sector. The result is often a debt-financed investment boom and rising asset prices. When the cycle turns, we see the opposite. A sharp fall in asset prices, tighter lending conditions, and potentially harsh downturns with high unemployment. The basic insight is not new. In 1933, the American economist Irving Fisher used strong words when describing the relationship between debt accumulation, asset prices, and economic cycles. He argued that asset price booms and high levels of debt were economic maladies and the most important causes of severe economic downturns. This was after he was hardly hit himself by the 1929 stock market crash. A sense of bitterness can be seen in his writing. He was at the time infamous for his claim, just prior to the crash, that the stock market had reached a new permanently higher level. Fisher went on to describe several episodes in the late 1800s that displayed the same pattern. Recessions that follow periods of rapid debt accumulation and strong asset price inflation tend to be deep and long-lasting. The Norwegian banking crisis in the late 1980s, one of the worst financial crises in advanced economies in modern times, according to Carmen Reinhardt and Kenneth Rogoff, is an example of this. Real house prices declined by 40% and did not return to pre-crisis levels for more than 12 years. The number of unemployed tripled, and the three largest banks in the country collapsed. Similarly, many European economies caught up in the global financial crisis have only recently returned to the pre-crisis GDP level. This taught us the value of good regulation and supervision of the financial sector, which has been an important policy objective for all Norwegian governments since the late 1980s. In the past few years, many countries have once again experienced rapid growth in asset prices and an accumulation of debt that once again has raised concerns about the build-up of financial imbalances. High household indebtedness is a severe risk to the economy. In Norway, households currently have an aggregate debt to disposable income ratio above 200%. This is one of the highest levels among the OECD countries. While household indebtedness has fallen in many OECD countries in recent years, including in the UK, it has continued to increase in Norway. This makes households vulnerable to changes in income, interest rates, and house prices that could result in an abrupt adjustment in consumption. A comparison of debt levels across countries may of course be complicated by differences in the financial system and other institutional characteristics. Nevertheless, increasing indebtedness over time may suggest that downside risks are increasing. Several cities, including recently London, have witnessed sharp increases in house prices in recent years. London, Stockholm and Oslo are shown in this graph, but cities like Toronto, Sydney and Berlin could be added to the list. An extended period of low interest rates may be one reason for this pattern. There are studies that show that house prices are more sensitive to interest rate changes in places where land is relatively scarce, which usually is the case in cities. Strong investor appetite for urban properties in recent years, both commercial and housing, is an additional factor behind accelerating property prices in cities. The rapid increase in house prices and debt has prompted authorities to take action. The package of policies taken differ across countries, and I will come back to the measures that we have introduced in Norway. Recently, several cities have seen a price correction. One common factor is that interest rates have either started to increase or are soon expected to increase. However, local factors are also important. Here in London, prices declined after the Brexit referendum. In Stockholm, prices fell rapidly last autumn after strong growth in previous years. And in Oslo, we have welcomed the gradual correction in house prices after years of strong growth. Banks and other financial institutions have an important role to play in channeling funds from savers to those who want to borrow to buy a house. Banks are profit-maximizing institutions. It is well known that banks have incentives to take greater risk than socially desirable, and their behavior can amplify upturns and downturns in the economy. Incentive problems arise because an important group of creditors, the depositors, are not able to efficiently monitor the bank's behavior, and because the price of deposits, the deposit rate, does not necessarily reflect the risk profile of the bank. At the same time, bank executives can earn large profits by investing depositor savings in high-return, high-risk assets. This distortion may be amplified by deposit guarantees and expectations of government bailouts. When banks get into trouble, it's not only shareholders, creditors and depositors that are affected, but also the economy as a whole. First, banks can become less willing and less able to lend. This can make it harder for firms and households to finance their investments and cause a decline in economic activity. Second, because the financial sector is more closely integrated than ever before, problems in one bank can easily spread to other financial institutions and thus have implications for the financial system as a whole. Thirdly, there are many examples that bank collapses and ends up in higher public expenditures due to big-to-fail challenges. For these reasons, it is in the public interest that financial institutions maintain sufficient financial buffers on both sides of their balance sheets to draw on in harsh times. Individual financial institutions have few incentives to take into account the risk they pose to the financial system as a whole and the economy more broadly. In financial institutions, if financial institutions were free to choose these buffers themselves, they would probably choose smaller buffers than what is socially optimal and necessary in order to safeguard financial stability. As a politician coming from a libertarian political tradition, I believe in freedom of choice and a limited government that empowers people and businesses to achieve their goals. I generally believe that the free market will find the best outcome, and I therefore prefer to avoid regulation whenever I can. However, The knowledge that strong growth in house prices and debts can cause much harm to the economy, and also the important role of banks, implies that regulating the financial sector is necessary to safeguard financial stability and to ensure a safe housing market. As the Minister of Finance, I also have to keep an eye on state expenditures, as it is often the government that has to come in when big banks fail. We need to strike a balance. We have to accept that there is a need to regulate the financial sector, but we should never forget that the art of banking is better handled by bankers than by politicians. Promoting financial stability is different from many other areas of economic policy making. While economic policy generally aims to achieve the best possible outcomes, like maximizing welfare for its citizens, policy promoting financial stability are aimed at preventing the worst possible outcome. Hence, these policy areas are by nature quite different. When we introduce policies to promote financial stability, our goal is to prevent crises from happening, and if they do happen, we want to make sure that the consequences for the economy are as small as possible. Most areas of economic policy, like monetary policy, have a clear objective and well-defined tools. Financial sector policies, on the other hand, are aimed at the broad set of objectives that are difficult to evaluate ex post, and the set of policies available consists of a diverse set of tools that influence the objective in different and indirect ways. Regulating banks and financial institutions is the first line of defense against the build-up of risks in the financial sector. Policies that promote the resilience of the financial sector reduce the likelihood that the behavior of the individual financial institution will have systemic implications and spill over to the real economy. In recent years, macroprudential policies have become an important part of the toolkit. Macroprudential policy aims to address systemic risks, that is, risks to the financial system as a whole. While prudential regulation traditionally has been oriented towards addressing institution-specific risk, the financial crisis made us more aware of risks that affect the entire system. Examples of systemic risks include contagion risks that arise from strong linkages between banks, exposure concentration on risk related to the buildup of financial imbalances. Macroprudential policies to address systemic risks include additional capital requirements, liquidity requirements, or restrictions on banks' lending practices. I will come back to our integrated approach to promoting financial stability later, but first I will take a few minutes to discuss the role of international financial market regulation. I'm just going to have this. Today's economic landscape is characterized by highly integrated financial markets, increasingly sophisticated financial institutions operating in several jurisdictions, and a rapidly changing global regulatory environment. When risks materialize, they can spread fast between institutions and countries. There is always a risk that financial services will be provided from jurisdictions with weaker regulation. Harmonized financial regulation is beneficial for the efficiency and stability of our financial market, allowing for well-functioning cross-border operations. More integrated financial markets, and in particular the international financial crisis in 2008, have led to an effort by the G20, the Financial Stability Board, and the IMF to develop a set of common international standards and rules for the regulation and supervision of the financial sector. The Basel Committee on Banking Supervision has formalized these efforts into broadly accepted standards and guidelines. The first set of common standards for banks, the first Basel Capital Accord, was introduced in 1988 and has since been supplemented by two accords, the Basel II and Basel III. Most advanced jurisdictions, for example the US and the EU, have transposed these standards into legislation. I understand those who argue that international common standards for governing the financial sector have become too large and complex. The chief economist at the Bank of England, Andrew Haldane, made this point loud and clear, simply by counting the pages of the different vintages of the Basel Accord. I'm also well aware that some of the regulations that has emerged after the financial crisis resembles old wine in new bottles. More generally, we must not forget the reasons why we abandoned the intrusive regulatory environment of the 1950s and 60s, and we must strive to avoid unnecessary regulation. The global financial crisis demonstrates clearly, however, the need to impose sensible regulations on the financial sector. It is my firm belief that if Basel III is successfully implemented throughout the world, the global financial system will be better able to weather the next financial crisis. However, it is critical that we work together. When talking to industry representatives in Norway, a major concern is unlevel playing fields, differences in capital requirements between countries, and the scope for regulatory arbitrage. Region-wide regulatory frameworks, like in the EU, ensure a good degree of harmonization of rules across countries. As a member of the European Economic Area, Norway has an obligation to implement most of the financial regulations adopted in the EU. The UK's neighbouring countries, including Norway, have an interest in the UK continuing to implementing the Basel Accord and other important standards, also post-Brexit. And we have an interest in the UK continuing to endorse the idea of common rules and a level playing field. Countries with highly integrated banking sectors may also benefit from cooperating among supervisors to get a common understanding of risks and regulatory needs. In the Nordic and Baltic region, we have established meeting places and forums for discussion and cooperation, since several Nordic banks operate across the whole region. On the regulatory side, these forums make it possible to discuss local needs within regional contexts and have in several instances resulted in voluntary reciprocity of prudential requirements within the region. On the supervisory side, we have agreements about information sharing. The cooperation within the Nordic-Baltic region on bank supervision has served us well and facilitated the transition to a new regulatory regime after the financial crisis. While the rest of Europe was deleveraging after the global financial crisis, household debts in Norway continued to rise. This both allowed and required Norwegian authorities to be proactive in addressing financial risks. At times, we have chosen to implement the new regulations earlier than in the EU, and we have often used any available flexibility in the EU framework to tighten regulations even further. We have strongly promoted the build-up of own funds in the banking sector, and we can now see the results in international comparison of leverage ratios. Norwegian banks are already fully compliant with Basel III requirements, while many other European banks still have a way to go. Some parts of the financial market regulation has a macro-prudential focus and is more tailored to national needs and conditions. In particular, the use of macroprudential measures must acknowledge that countries may be at different stages of the financial cycle. At times, it may even seem as if there is an inherent conflict between the notion of common international standards and macroprudential measures that are set at an individual country level. We should continue along both paths, fighting loopholes in supervision and regulatory arbitrage, as well as emphasizing host country regulation and supervision. Let me now address the measures taken in Norway to promote financial stability. Up until a year ago, Norway experienced strong and accelerating growth in house prices. Household debt was, and still are, growing steadily faster than income. As a result, we have found it necessary to take several measures to address this increasing vulnerability in the household sector, and especially the housing market frenzy. A simple rule of thumb could be that double-digit growth in housing prices should raise concern. After several years of brisk growth, house prices in Oslo approach an annual growth rate of 25% at the end of 2016. And in such a situation, the warning lights should flash. In addition to stricter requirements on liquidity and capital, including a counter-cyclical capital buffer of 2%, we have introduced a regulation on mortgage lending. The aim of introducing this regulation, first in 2015 and again in 2017, in a somewhat stricter form, was to contribute to a more sustainable residential mortgage market. So far, the measures seem to have worked well. The share of new mortgages that are very large relative to income and house value has been reduced. Also, housing prices have stopped growing and even declined moderately through 2017, as you might have noticed from the previous graph. The regulation included a limit on the loan-to-value ratio of 85%, a maximum debt level of 5 times your gross annual income, and an amortization requirement on mortgages with a high loan-to-value ratio. Banks have flexibility to provide loans that do not satisfy all requirements, a so-called speed limit of 10%. In Oslo, where house prices have risen considerably faster than in the rest of the country, we introduced a more restrictive limit on the loan-to-value ratio for secondary homes and a lower speed limit. The flexibility for banks to do a proper credit assessment was an important part of the regulation, and that is why we included the speed limits. Other countries have introduced mortgage lending requirements, have also set speed limits, including the UK. I believe this is where we depart from the regulatory doctrine of the post-First World War period. We acknowledge the need for regulation, but we are cautious not to regulate banks so heavily that we effectively take over the responsibility for their business. Regulation should be crafted in a way that leaves banks with responsibility for running their businesses. The current regulation expires in late June this year. We are in a process of evaluating its effects and the need to keep it in place. A public consultation is soon to be completed. In general, requirements that respond to transitory events should also be transitory. However, to keep some limitations on the size of mortgages, for example, related to home value and income, may be sensible, regardless of the state of the economy. The traditional policy tools aimed at promoting financial stability are mostly geared toward building capital and liquidity buffers in banks, household and firms. Their ability to address the underlying accumulation of risks, however, is less clear. We have ample evidence that a more solid capital base makes banks less vulnerable to negative shocks. But we have little evidence that high capital requirements are effective at preventing the build-up of financial imbalances. Similarly, requirements on mortgage lending can reduce the number of vulnerable households, but their effects on overall debt accumulation is less clear. A cross-policy approach is therefore warranted. Fiscal policy, monetary policy, structural policy, and financial market regulation need to work together to deliver a stable financial system that can contribute to society's broader economic and social objectives. Both monetary policy and fiscal policy have important roles to play in counteracting the build-up of financial imbalances. Contractionary macro policies during an upturn can help prevent the build-up of vulnerabilities. Similarly, expansionary macro policies during a slowdown can help prevent the rapid leveraging of balance sheets that can amplify a downturn. In most countries, monetary policy has the main responsibility to stabilize the cycle, while fiscal policy steps in when the fluctuations are especially pronounced. In Norway, fiscal policy is guided by a fiscal rule. The rule, which enjoys broad support among political parties and society as a whole, states that the expected real return of our state-owned oil fund, estimated at 3%, can be spent every year. However, the rule leaves significant room for counter-cyclical fiscal policy to help stabilize the real economy. The tax system also has an impact on financial stability. In recent years, the Norwegian government has introduced several measures to aim to make speculative behavior in the housing market less profitable. To encourage home ownership, we maintain a low tax regime on primary housing. However, the valuation of secondary homes for the purpose of determining the wealth tax has been increased several times in recent years and is now more aligned with that for other financial assets. By lowering the tax rate on capital income, we have also reduced the tax value of interest rate deductions on mortgages. We believe these changes to the tax code will help curb risks in the housing market and make it easier for ordinary people to buy their own home. The supply side of the housing market is important for housing market developments. We have launched a comprehensive housing initiative to increase the supply of new houses, including an overhaul of building standards. The result of that policy are clear. Housing construction has picked up and has contributed to end the accelerating house price growth. Now let me come back to monetary policy, as the level of the interest rate is an important factor behind the growth of house prices and accumulation of debt. Low interest rates have made it possible for households to take on more debt, which in turn has pushed up house prices. Most European economies and other industrialized countries are finally back on a solid footing after a decade of poor economic performance. This has gradually relieved some of the pressure on monetary policy to stimulate the economy and provides an opportunity to discuss the relationship between monetary policy and financial stability. More specifically, should we reassess the common view that monetary policy should stick to its traditional objectives of stabilizing inflation, or should it take on a broader mandate? The primary goal of monetary policy is to stabilize inflation around the inflation target, using an instrument that affects the economy through a range of different channels. To achieve price stability, monetary policy aims at stabilizing the economic cycle. Still, monetary policy cannot be expected to take primary responsibility for ensuring financial stability. However, it can contribute by taking into account the risk to the inflation outlook from rising financial imbalances. The Norges Bank has traditionally put some weight on preventing the buildup of financial imbalances in setting the policy rates. In particular, Norges Bank has noted in its communications in recent years that the policy rate has been set slightly higher than warranted by inflation and output considerations alone. In Norway, there has been broad support for this approach. Internationally, however, the debate about whether or not monetary policy should help promote financial stability by leaning against the wind of financial imbalances rages on. In the recent update of Norges Bank's monetary policy mandate, which was announced on March 2nd, the government decided to explicitly include financial stability considerations into the statutory objectives for monetary policy. Stabilizing inflation around the inflation target remains the primary objective for monetary policy, but we also explicitly stated that monetary policy should be forward-looking and flexible so that it can contribute to high and stable output and employment and counteract the buildup of financial imbalances. It is important to note that the role of financial imbalances is asymmetric. Norges Bank should put a weight on financial stability considerations when risks are assumed to be increasing, but not necessarily loosen policy if risks are assumed to be declining. This represents a change in the statutory mandate for monetary policy. However, in my view, it is unlikely to alter how the policy rate is set, as it is largely a formalization of how Norges Bank has been conducting monetary policy. The bank also shares this view, something they have stated clearly in public. The new monetary policy regulation also lowered the inflation target from 2.5% to 2%. When the inflation target was first introduced in 2001, the Norwegian economy was entering into a period of large increases in the amount of oil revenues that were being phased into the economy. This was assumed to entail real appreciation, and the view at the time was that the smoothest way to achieve this was through slightly higher inflation than our trading partners, rather than a strengthening of the kroner. We now believe that phasing in of oil revenues is close to its peak, and so the argument for aiming for a different inflation target than our trading partners is no longer present. We therefore decided to lower the inflation target to 2%. We are, of course, well aware of the debate about whether inflation targets should be increased so that real rates can be lowered further when the effective lower bound of nominal rates is reached. There may be merit to this argument, but to my understanding, such a move would require coordinated action by the international community in order to prevent disruptive exchange rate movements. So let me sum up. Financial crises come at great costs to society. Following the housing market crash in Oslo in 1899, large fortunes were lost and a number of apartments stood empty for years. It was only in the booming 1980s, 90 years later, that housing prices, after adjusting for inflation, were back at their pre-crisis levels. At the time, another banking crisis was already brewing. Today, despite a few rough years in the Norwegian economy and a cooling housing market, I still see plenty of cranes when I look up at Oslo's skyline. Our broad approach to financial stability has proved useful to mitigate the buildup of risks in the housing market in recent years. Building buffers in our financial system is the best way to make our economies less vulnerable to the consequences of financial disruptions. In an international environment where banks' activities no longer are limited to domestic markets, and where financial unrest quickly affects multiple countries, we need international solutions. International cooperation on regulation of financial markets is in the interest of all countries. This includes Norway as a small, open economy with close ties to the rest of Europe, and the UK as the world's leading financial centre with close ties to the rest of Europe. The UK has played an important role in developing the European single market for financial services. Norwegian and British views have often been aligned. Independent of Brexit, there will be a need for close cooperation and coordination on financial market issues in Europe also in the future. And I am sure the UK will continue its efforts to promote sound and safe financial institutions and work toward a level playing field internationally for the financial sector in the years to come. Thank you very much.
Well, thank you very much indeed. And I think you're game even to try some questions.
Let's try.
Now I told you that you had a good speech. And what's interesting about the speech, not only does it actually rehearse many of the challenges in contemporary monetary policy and in the wider background, because as far as I'm concerned, still monetary policy and fiscal policy in many jurisdictions remain effectively fused as opposed to separated, because a lot of banks still actually greatly rely upon the taxpayer one way or another through their central bank supporting them. But it's a sharp reminder there are more things to Brexit. Whatever else happens after Brexit, these very complex issues, which you have rehearsed very neatly for us, will go on. So I'm going to ask the questions. If you could marshal it into a question, And if you make them short and pithy, so we probably should be finishing around 10ish, I think. Start with the gentleman there. Could you give your name, your affiliation, and wait for someone to amplify?
Thank you very much. I'm Martin Sandby from the Financial Times. Welcome to London. Thanks for a fascinating speech. I was wondering if you could elaborate on your remark that Norway has an interest in the UK continuing to respect common rules and a level playing field in finance after Brexit. Prime Minister Theresa May, while keeping open the possibility that the UK will align with European regulations on, for example, goods standards, has explicitly said that the UK can't be a rule taker in financial services. So should we interpret you as saying that if the UK uses its regulatory autonomy to diverge from European regulations in finance, you would regret that outcome?
Let me answer that question just by elaborating what I already said. I think that we agree to the need for international regulations. I think that has served UK's interests, and it has served Norwegian interests, and it serves probably the rest of the world's interests as well. And UK, and especially London as an important financial hub, I think will have a special interest in being regulated as their neighbouring countries, because it will make it easier for institutions, for banks, businesses to operate across borders. And this is becoming more and more important for businesses across the world. So I think good international regulations will be of interest to the UK even in the future, no matter what happens with Brexit.
Gentleman there. If you could just give your name and your connection.
So Alex Murray from the Infrastructure and Projects Authority in the Cabinet Office. Thank you for a great speech. You talked a lot about the housing market, the sort of demand side of prices, and you touched on housing supply and the industry. I want to sort of get your views on how we increase the output of real estate developers, because it's an issue we have in the UK where you get planning permission and a developer is mandated to start building within 2 years, but then they just get in the system, they start doing some foundations, they're putting in some groundworks, and then they sit back because they like to land bank. They like to wait until house prices go up, and in essence, you need the land or the building to develop, and that's a monopoly for that particular site. So what have you been doing in Norway to encourage more competition in real estate development and to get people building?
I think the most important thing from the government's perspective is to facilitate a quicker balance of supply and demand side, because that was actually the main problem, especially in the big cities. And the tools that we had to simplify that was actually, as I said, through easing regulations. And when we eased the regulations, we reduced the costs, building costs, especially on the smaller units, smaller houses. And that's, I think, facilitated and stimulated building. So what we see now is that for the second half of this year, many houses will be built and enter into the markets. And I think that, of course, will also affect the supply and demand side of the housing sector, especially in Oslo.
Hi, Abhinav from Reuters. You talked about potential for regulatory arbitrage, Trump, for example, there's been some concerns over him scaling back on Dodd-Frank. Do you think that that could give U.S. banks an advantage over European banks, and also potentially could it lead to a sort of race to the bottom as far as banking regulation is concerned?
I have to think a little bit about that question, I think, before I can answer it. Let me think about it for a while. Is that okay? Yeah.
Joss, well, I call it a policy exchange.
Hi there, I'm Joss, Policy Exchange. I have a question specifically about peer-to-peer lending and what which obviously is a little bit less developed in Norway than in Sweden and Denmark, where you actually have had the founder of the largest Swedish peer-to-peer platform is actually Norwegian, but chose to set up in Sweden originally because of the favorable regulation there. The majority of peer-to-peer lending in the Nordic market is to do actually with housing, real estate development. And so I was wondering how you see European-wide rules on kind of alternative finance, peer-to-peer lending, and Norway's approach specifically, how you see that developing, or your thoughts on that. It's a very specific question, but...
Yeah, but it is, but it's also difficult to answer, because I think that we have seen these things develop differently in different countries. In Norway, alternative finance is not really as big yet. So the debate on this has just started, and we are looking into how to stimulate it, how to regulate it. But I think for now, at least, it's the more traditional banking sector that is of vital interest to basically both businesses and the average Norwegian. But the interest is coming in Norway as well, but not as fast as we have seen in other countries.
The question I would actually all the things you've actually touched on about monetary policy, the potential for having to not simply focus on your macro story in terms of economic management, the price level, but also thinking about some of the microeconomic consequences of monetary policy in terms of interest rates and leading to financial instability and a palette, if you like, of interest rates that can't reflect the full pricing of risk within credit markets. And all things that Policy Exchange are very interested in. We do a lot of work on the housing market, because I mentioned we have problems with our own local housing market. But one of the things that I'm increasingly interested in is the extent to which there's a real tension with things that we actually want. So we want competitive banking systems, financial services that offer consumers things they like and business things that they like. But there's a tension between that dynamic competitive system that's responsive and the stability that we also want. And I'm very mindful that the most stable banking system probably was in Canada in the last crisis, precisely because it's got a banking system that doesn't respond to its businesses and its customers. It can be rather awkward with them, but it was very stable, just as the UK banking system had high degrees of cartels and was very stable in the 1930s. Do you think there's any tension between what we actually want on a credit system that really works, does the things we ask it to do, and the stability we also feel we need?
Of course there is a tension. That tension is, I think, you'll find in any markets. But I think I was very thorough on that subject in my speech. Of course, when we have been through a period of regulating our banking sector, it has not been without opposition, without people raising their voices. But when we now see the results of what we have done for a long time actually, it has left us with very solid banks that can resist future crisis. And that is of vital interest to the customers of the banks, the consumers, and the economy as a whole. So I think we have managed to strike that balance quite well, and now I think the objections is no longer as outspoken as they were. And I think one of the reasons why we have been very successful in doing so is the hard-learned experiences that we actually had from our own banking crisis. And that hit us before the financial crisis hit the rest of the world. So we started implementing measures long before the rest of the world actually woke up. And I think that gave us an advantage when the financial crisis actually hit, because it did not really affect Norwegian economy as hard as it did in many other countries. I think that is especially due to that we had implemented many regulations already. But banks are solid, extremely solid. And I have not heard from consumer side or from business side that there is a difficulty when they apply for loans at all. It's actually a very well-functioning market.
That's actually a contrast to here. There still are issues of people trying to go about sort of everyday transactions, including things like probate loans. You can be rather surprised at some of the results they still encounter.
Yeah, but as I also said, I mean, we have, when we, even with the regulatory framework that we have put to try to stop the increasing indebtedness of the households, it was still important for us to have the necessary flexibility to leave the banks, to be able to make that decision towards the customer. But of course there will be individuals feeling it's very unreasonable that they are declined a loan. But everybody should be aware of the fact that when you get a loan in the bank, you need to pay it back, even when interest rates go up. And that is, of course, a future risk. Also in Norway, we have had low interest rates now for a very, very long time. And we know, the Norwegian bank has stated very clearly that now the level is going up. And that puts an increased burden on households when paying back their debts.
I think we've got time for one more question. Any more takers? FT again.
We'll have a second one.
Yeah.
Thanks very much. You mentioned old wine in new bottles, but there's one principle in current European bank regulation that I think is generally new. I have in mind the principle of bailing in bondholders in failing banks. Since 2012, when banking union was started in the EU. Now that is a new principle. It was resisted at the time. It's still resisted in some countries today. Could you talk a bit about how Norway has implemented the Bank Resolution and Recovery Directive and the bail-in part in particular in its rules? And has it been a problem for you as Finance Minister and democratic politician to implement these rules, not being a member of the EU and part of the formulation of those regulations? And what do you think of bail-in as a principle, more philosophically, generally?
That was a very technical question. Let me answer it by saying that, and I touched upon it in my speech as well. I mean, as a member of the EA agreement, we are obliged to implement EU regulations in Norwegian law. And we do so, and as I said, we have done so at high speed as well, especially in the capital market, because we have seen it necessary to do so. I have not experienced great objections in the Norwegian debate towards this, because I think the general assumption, especially in the public, is that they feel safer when the banks are solid, when they are well regulated, and when they are regulated and harmonized with the markets that we correspond to. And Europe is an extremely important market to Norway. It's by far our biggest trading partner. And seeing harmonized regulation, I think, is one of the most important things to our economy. So it's not really very difficult for me as a Minister of Finance to implement these regulations at all. And I think, but in a broader perspective, because I think this is something that you will debate more and more in the aftermath of Brexit, is what kind of a deal will UK end up with towards the European Union. And I know that you have been discussing from time to time whether or not the Norwegian way of doing it is a way for UK, but it's obviously not, since we are for us access to the single market is extremely important, and I think already there you find some of the red lines from UK when it comes to Brexit.